the day up about 2% today and about 7% on the week. So lots going on and lots of different drivers.
Yeah, and we should mention that you have ETFs more geared towards, here in the U.S., we basically have the California market on the one hand. You can literally get your ETF for just that. You mentioned Reggie, the issues with Virginia, that's a separate issue. But for carbon itself, for the flagship, it seems like Europe is the big driver. And it really seems like for global energy prices, Europe is the big driver. So there we had people thinking maybe carbon emissions, the price of emissions per ton was going over $100. Now they're thinking after the last couple of days, not so much. But what would you say if we were to go back above 100, which would have seemed crazy at the beginning of the year? What would be the reason why?
Well, we've always had our eye on this 100, and that's the sort of the bogey that we've been seeing as this is the number we need to get above to really catalyze reduced emissions and really start to see these programs swing into action. And it seems like there's maybe a psychological level there because Europe hit that 100. I think we peaked about $101 equivalent. Obviously, it's priced in euros. And then we had this sell-off. The pound, the UK market, which we just recently added to KRBN, is hitting $100 equivalent right now as we speak. So it really is interesting to see that level seems to be a bit of resistance there. Maybe there's some profit taking at that level. But for us, the long-term view is that the market, as supply keeps coming down, remember, these are structured markets that have supply that drops in Europe. You mentioned Europe as the main driver. The supply is falling by over 4% every year, and there's a market stability reserve picking up about 24% of every auction. Yeah. So the supply is the big driver. The supply keeps coming down, and although we want to see demand fall, i.e. emissions fall, I don't think it can keep up with the reducing supply. So that's going to be the catalyst for the forward rise.
I mean, maybe a different way to put this is that policymakers want the price of carbon to go up. The cost of emitting a ton of carbon, they want it to go higher because that's what helps achieve net zero goals. It seems like a no-brainer investment, I guess, unless people reduce their demand for it. But in this environment, Luke, when we're talking about shortages of nat gas, strong demand for gasoline, is there still enough of a financial incentive for big players, power plants and the like, to provide fossil fuels to the market?
There is. Well, you mentioned the sort of no-brainer side. It certainly feels that way sometimes, but we have to remember these are volatile markets. I mean, the volatility of that global basket of carbon has been double that of equities over the last 10 years. So there is risk with these returns. I think that, there is a transitionary correlation to fossil fuels. As we've seen that gas continue to rise in Europe, that opens up the ceiling for carbon prices to rise with it because, of course, as people move away from coal towards natural gas on their way to renewable sources, that puts extra demand on natural gas. So the two will have some correlation there. But I think you mentioned something about the fact that you have these regulatory bodies angling for and engineering these markets to rise. And I love the analogy that these are like central banks. So as they see, they have the ability to ease, but certainly their aim is to keep tightening, keep pushing this price higher. As the price rises, we mitigate more carbon. So being invested in carbon allowances participates in that upside, but also actually helps reduce emissions and actually catalyzes not just these energy companies to continue. I mean, these energy companies that are they must buy these carbon allowances. But what I actually like most about this, not that they switch energy sources, but they actually start to invest in greener technologies and more efficiencies that will actually accelerate the move towards lower emissions over time.
All right. Luke, we'll leave it there. Certainly won't be our last conversation, I'm sure. Luke Oliver joining us from Crane Shares.
And still ahead, the great heat divide. Poorer neighborhoods are hotter than wealthier ones, and that's the finding of a recent study. Our Rising Risks series looks at the impact on local economies. Next.
The Bond Report is brought to you by PIMCO, a global leader in active fixed income.